This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Wednesday, March 4th, 2015. The market is pulling back, second day in a row that we've pulled back a little bit. I'm going to take a look at a couple of charts to try to get a handle on whether this pullback might have further to go and where the ultimate upside targets might be or downside targets might be. And we'll also take a look at some liquidity indicators, some economic measures. Of course, the jobs report comes this week. The federal tax collections in the week of February, during which that survey is taken, were extremely strong. The survey of private payrolls that ADP does came out today, and it was modestly higher. I think the number was 250,000. Last month's number, they had to revise up very substantially from about 213,000 to about 250,000. So they have a hard time, both the ADP survey and the government survey has a hard time on the advance report that comes out in the month following the reference month. We shouldn't give a lot of weight to these numbers, but the market does. It always reacts, and then it doesn't pay any attention whatsoever to the revisions which follow, which are multiple. But with the withholding taxes rising as fast as they were, somewhere around 8% growth rate in early February, that would suggest that we're going to have a very strong jobs number that will probably surprise the consensus of Wall Street economists. Beige Book came out today. Nothing in there that we haven't heard before. We've been watching the data, moderate growth. There's nothing in the data that would suggest that the Fed is going to change course. The Fed's big problem isn't when to raise rates, it is how it's going to raise rates. It knows it has this problem. So the question is whether they're going to stay on track for threatening a June rate increase when they know in their heart of hearts that they really probably aren't going to be able to control short-term rates all that well with all this excess cash in the system. Last week I mentioned that I want to keep an eye out for any sign that they're going to start talking about selling assets in order to remove reserves from the system and push rates up that way. Haven't seen a word about that, so clearly that's not on the horizon yet. So I don't know whether they're going to stay on track for a mid-year rate increase or attempted rate increase or not, unless one of the Fed heads starts talking about the fact that they recognize they're going to have an issue in controlling short-term rates. Then we don't have much to go on. And the other issue is whether or not they start talking about withdrawing reserves, selling assets. If they get to that point where we start hearing them talk about selling assets, I would think that means that they're getting serious about raising rates. But with a 2.5% growth rate in GDP, I don't think they're going to be in any rush. But if the economic data starts to heat up a little bit and we start seeing plus 3%, plus 3.5%, I think that's going to put increasing pressure on them to act. Well, Greg Ip had a post today or yesterday in the Wall Street Journal talking about NASDAQ reaching the 5,000 level that it hit in 2000 when it topped out the top of the internet and tech bubble at that time. Of course, it's not the same index at all. It's not the same stocks. The few stocks that were around then that are still in the index, it's not the same weighting. Apple is 10% of the index now. Back then it was hardly anything. And Microsoft was the big dog. And there were a number of internet stocks that had significant weights that are no longer around. So it's not the same index at all. You can't really compare the PE ratio of the NASDAQ index in 2000 when half the stocks didn't have any earnings at all and were going to go bankrupt. Sure, I mean, that was maybe one of the greatest bubbles of all time. Are we in a bubble now? I don't know. What we're in is a central bank-driven fraud of a market. So I don't know if it's technically correct to call it a bubble or not. When you look at the shape of the chart, it certainly looks like virtually every other bubble that has ever formed in the past looked. So from a purely technical perspective, it sure looks like a bubble. Now, if you want to use valuations as a measuring tool for whether it's a bubble or not, be my guest, but I don't think it's relevant. I just think there's too much manipulation of earnings. The earnings per share are rising, or at least not falling, because they've been shrinking the number of shares. They're buying back stock all the time. So I just don't think that you can use valuation measures as a measure of whether or not the stock market is in a bubble, nor do I think that semantics matter all that much. As long as the central banks are driving this thing, then the market is probably going to trend higher. One of two things has to happen. Either the central banks get tired of it or start to worry and decide it's time to pull the plug, in which case I think there's going to be hell to pay, or the transmission mechanism breaks. Now, is that likely? Probably not. I don't see it in the near term. There's still a very strong correlation between the liquidity measures and the direction of the market. And until I see some sign that that's breaking, I don't see any reason to expect the market to fall out of bed as long as these liquidity measures continue to uptrend on a straight line. On the other hand, oil is a very important market. It is the money substitute for the world's wealth, and it broke. So we can't simply assume that stocks can never break as long as these central banks are pumping money into the primary dealer network so that they can manipulate stocks higher. We just can't make that assumption. We have to rely on the technical analysis and on the liquidity measures, and we have to rely on whether, as we go week to week and track this stuff, whether we see any sign, any inkling of change. And looking at the liquidity measures, and as they relate to the price measures, I don't see any sign of change. Now, in the technical measures of the stock prices themselves, the short-term projections are still from just above where we peaked last week in the low 2100s to maybe 2150, 2160. So we're still in the splitting hair zone where the market could make a run a little higher over the next month or two. Don't forget, in April, there's an enormous pay down of Treasury debt. That cash comes rolling into investor pockets, and they're prone to put some of that out into the stock market. So we'll keep an eye on April after the 15th when this cash comes in. Normally, there are pay downs for 2 or 3 weeks after that. So that second half of April, first week of May, looks like prime time for the ultimate top. But we could get sell signals earlier, so let's take a look at some of the charts and see what they're telling us. First chart I want to look at with you is my proprietary composite liquidity indicator that consists of